Okay, ladies and gentlemen, thank you for joining us for our MetaStock webinar today. We're excited to hear from Andrew Abraham, a good friend of MetaStock and a great presenter. I was just mentioning to Andrew a moment ago that I always love attending his presentations because of his excellent common sense approach to trading. He has some really, I think, important things to say to help you simplify and keep you trading, keep your head and your wits when you're trading. Let me give you a brief introduction to Andrew. You know, he's written actually a couple of books that are pretty important, and I'm sure that you've all heard of them before. There are a couple of books called The Bible of Trend Following and The Bible of Compounding Money. The Bible of Trend Following has been around for a while. The Compounding Money book's been out just more recently, but two excellent books, ones that traders should really have on your shelf and you should definitely read. Before we start, of course, we need to have our standard disclaimer. Go ahead and take a moment just to peruse that. There you go. And if you need any questions, essentially we're just not going to be held liable for any investment decisions based on the software or any strategies that are presented today in connection with MetaStock. And now we'll turn the time over to our good friend Andrew Abraham. Andy, go ahead and take it away.
Okay, thank you very much, Dave. Can you put on the, there you go, you read my mind. I'm almost chuckling because I made this PowerPoint in this presentation because we just came out of a slight correction. And why I'm chuckling is I just read an article about, actually it was about Peter Schiff and others that are calling for the next massive bear market. And you know what the fact is? Maybe they're right, maybe they're not right, but the tools that I'm going to present you tonight are going to assist you in order to stay on the right side of the market without listening to anyone's opinions, that you'll become your own, let's say, so-called guru and not be seeking others' advice. I also have a disclosure. I also am a money manager, so here's my disclosure. And some of the things that we'll be showing are hypothetical. Some of these trades I did not actually take, but it's just exactly for educational purposes. Dave mentioned two of the books that I've written. Here they are. As a bonus, what I did the last time when I made a presentation with MetaStock, I offered to give away this book for free. All you do is you can email me, and at the end, I'll put my email up, and I'll send you a copy of the book. It's on Amazon, but I can send you the, looks like a PDF kind of version, which I think, I mean, really my goal is to share, and it's the way to get back. Because I had others that have helped me over the years, and the reason I'm doing this presentation is really to help you, and to help you become better traders. And don't think this is watch a couple of videos and or go to a weekend course and you'll be up and running. I've been trading since 1994. I study all the time. I'm learning all the time. I'm looking to better myself. I have trading journals, and I always look back at my mistakes that I've made, and that's kind of how you become a little bit of a better trader. So basically, I'm no Peter Schiff. I'm no Mark Faber. I don't have opinions if it's going to be a bull market or a bear market. I look at where we are today. And then from that point, I draw my conclusions of what I should be doing. And the reason to know before we do anything is you need to know where is the market. Because the fact is, depending on who you want to ask, and I'll tell you from my experience over the last 20 years now, 3 out of 4 stocks are going to follow the direction of the stock market. So that is the essence of this discussion. How to stay in sync with where we are in the stock market. And again, without listening to any gurus, because there are no gurus. I mean, when I started, there was the talk of Granville, and he was right in '87 and then wrong all these other years. So it's not the way to make money. And in this discussion, I'm going to give you my exact rules, and I'll even throw it to you to make them to fit your own personality to stay on the right side of the market. And with these rules that are rather simplistic, they give you the, I don't want to say guarantee you, because that doesn't exist, because all we're dealing with is complete uncertainty. But the potential to avoid bear markets, and to benefit when there's bull markets. And basically you got two choices. One is you can go and find stocks, and what you really want to do is you want to find, again, when the market is deemed healthy, and I'm going to show you how I deem it healthy and actually give you the formulas that I actually use in MetaStock. And actually, I've been using MetaStock since 1994, and I really put my money where my mouth is. It's a great product. So you have two choices. You can buy leading stocks, like you want to buy the strongest stocks in the strongest sectors when the market is deemed healthy. Or another way you can do it is you can almost, instead of just doing an index fund, but you can buy like the spiders. These are all ETFs, the QQQ, or if you want to be more aggressive, the leveraged QLD, which is an enhanced version of the NASDAQ 100, or the TNA, which is an enhanced version of the Russell. And you can also just use these. So I'm going to give you these rules. And as you can see, well, we're going to actually go to MetaStock, but there's rules here which I call the Andrew Abraham buy. And when the market is healthy, you're in it. And you know what? It's not perfect, because what's going to happen is you never know how bad or how a downturn turns. And actually I have a separate slide. Dave, if I can I jump to my screen for a second on my PowerPoint?
Yeah, absolutely. Let me put that up here.
Hang on, I'm on mine, and I just want to show this. Does that show up right now?
It sure does.
Hang on one second. My screen is showing with this PowerPoint with stock market corrections. Can everybody see that, hopefully?
Yes, it should be showing now.
Okay. It's showing on mine, and basically it says stock market corrections. 71% of the time you have corrections that are basically around 8%. Then you have some that are between 8 to 12%, some that are 12 to 16, and then they diminish in frequency 16 to 20%, 19% of the time. Some heavier corrections, 20 to 38%, 23% of the time. And then some of the big ones that destroy people, when they're greater than, let's say, 38%, those are 15% of the time. Okay, we can jump back now to the regular PowerPoint that I'm running. Just jump back to where we were. What I'm trying to say is there are always corrections, like this little correction. But you never know if it's going to be a bigger correction, or let's say a 2008 correction, a 1987 correction, a 73, 74 correction, or 1929. So that's why you want to be prepared. Like I had a conversation with someone today. They said, why don't you just buy and hold? And then I just asked them a simple question. I said, okay, how did you do in 2008? And we, most of us recall that very vividly. The markets were down more than 50%. I don't want to go through that. But even this strategy that I'm going to teach you is not perfect. You get whipped around, but then you jump right back in again. You have to be diligent and follow the rules. And this is what successful traders do. They have an exact plan. They basically have the patience to let it work during this whole period, let's say. And we'll jump to MetaStock and I'll show you what I mean. And they're disciplined to follow it. As I alluded to, avoiding the 2008 bear market. This model, basically, this way this indicator works, which the good people of MetaStock helped me write, is you can see you benefited in 2007 and you avoided all of this terrible drawdown. These are the rules. And I'm going to throw it to you to apply it to your own, because what's for me doesn't mean it's perfect for you. And don't be fooled that it's so simplistic. It's very simple. But you know what? Like Einstein said, keep it simple and not simpler. And that's almost the genius principle. Basically, my numbers, because I'll tell you this, I'm a scaredy cat. I know what it's like to go through a drawdown. So I want to try to mitigate the big drawdowns. And you know what? Even using these periods, there are enough of these periods when the market is healthy to make some extremely healthy returns, which I'm going to show you. But the rules are very simple. The 10-period exponential moving average is greater than the 30, and then you're greater than the 200 exponential moving average. You've increased more than 3.5% from the lowest low over the last 100 days. None of these actual parameters are magic. You can massage them to your own parameters. Okay? You can exit when the 10 exponential moving average falls below the 30. And you fall 3.5% from the highest high over the last 100 days. This is the actual formula. And I can email it to you too. Before I get to this, Dave, can we jump to I want to jump to my Google Chrome. Can we jump to my screen again? Okay. How this model was built is basically, like I said before, I've invested not years, but decades in learning and trying to become a better and a more consistent trader. Part of my model, I said 3.5%, is based on Marty Zweig and Ned Davis. This is a book, as you can see, it's pretty old, from 1986. Well, guess what? This simple rule kept people out of the bear market or the debacle in October of 1987. What's also fascinating, I'm going to highlight this, for 30 years, and you can probably even go more, I would even say to 2014 till today, this 4% rule has given, I'm not sure if you want to add now, but you look on this 30-year period, 13.3% per year versus buy and hold, and that includes, again, if you want to look at 2008, 2002, you want to go to, again, you pick your poison, which market that want to crash to a 3.2% per year. So I took part of this rule, made it fit my own personality, which I suggest you also fit to your own personality, and very simple rules with moving averages. It keeps me on the right side of the market. Dave, we can jump back to the PowerPoint, please. Okay. You know what? Well, let me just jump to. Let me go before I go. I want to add another interesting thing, which also is more learning. Let me jump to MetaStock here. 1 second. Can everyone see my screen on MetaStock? Let me just jump back and make sure everyone can see it. Okay, Doc can see it. Yes, okay, great. So let me jump back here. Basically, very, very simple rules. And many, many, many hedge funds, and even my daughter works at a money management firm that actually, they didn't go short here. And then they started going short and got whipped around. It was interesting. I don't want to say the firm, and they were down 20% here in this little short period. Why? Because they didn't really have rules. Let's look at these rules. Here's the 200-day exponential moving average, which goes back to the ideas of Dick Fabian. And this is what I'm talking about, market knowledge, reading, learning, becoming a better trader. Dick Fabian wrote about the 200-day moving average, or he called it the 39-week rule. If you're above it, hey, you're in the stock market. That was his rule. If you're below it, you should be out. Well, a lot of times, like in many, many times, it might have gotten you out a little bit too late. So I added my rules. As you can see, here's a 10-period exponential moving average, and this is a 30. There's no magic to it. You can change it. You can make this a 50. You can make this a 20. But you know what? This indicator, which you can see here, keeps you in the market. It doesn't shake you out. Got pretty close. And then it shook you out when the market starts selling off here. And it's not perfect, but it will avoid bear markets for you and keep you available for bull markets. As you can see, I exited right here when this buy turned to basically not a buy, a sell, and then I went back long again. Nothing to think about. But you know what? A lot of people have a hard time following this because I do one-on-one mentoring and teaching people. I had very few of them that, students that were able to hold through all of this. They got bored or whatever. And especially here it got a little hairy. And you can see these bars. I have an expert advisor, let me show it to you, which I call Abraham Trend, which also the guys from MetaStock helped me write, which also just makes it, maybe a little eye candy, but you can see when the market's green, healthy. Yellow means it's a little bit under pressure. Red is, guess what, it's pretty negative. And then green. But we didn't get a signal here. This, just trading the QLDs, which are a leveraged version of the NASDAQ 100, returned from May to October 21%. That's pretty interesting. And if you want to look from this period, you do the math right from here. You have the signal from 125, 128, and we're at 137 today. Not so terrible. Before I jump to the other screen, why I wanted to go here, is you can see these little arrows. Another, let's say, heads up. Markets don't turn on a dime. They don't just come out of nowhere. What happens, and again, this is also coming back from Investor Business Daily and the Can Slim approach, where they talk about distribution days, where you have institutions selling, and they basically combine the idea of increased volume to the downside on negative days. And you count these distribution days, and invariably, even people say, oh, they don't work anymore. They give you a pretty good heads up when the market looks like it's going to turn. And what I do, if I have a clustering of them, which we did here, it was like 4 of them in a row in a very short period of time, that means a lot of institutions were selling here before we had this big drop, even though it wasn't so big and we bounced right back up. You tighten up your stops. You might even want to take profits. Before we jump back to the PowerPoint, so basically what I said in the PowerPoint is you can trade, again, if it's, you pick it. You can trade the spiders, the same rule, and here's the indicator right here. And you can put well, I didn't put it on here, but I'll put it on. Catch it. There you go. This is the spider, oh, sorry, this is the Dow. You can do gold. Gold has been pretty negative. You can see it's on a sell. This is the QLD. We did this one. This is a QQQ, just a regular NASDAQ. You can see again, you had more distribution days than we turned down. And also look at the volumes. Always good to watch the volumes. And a lot of volume here. With this. And the spiders. But it keeps you in sync. Look at this move. From here, when the market was healthy, I mean, who wouldn't want to be on this trade? You go from 170. You don't have to do that much. It's really takes you maybe 10 minutes, 5 minutes in the day. Then you catch another break. It's a heck of a lot better than going through. Let's go to, well, here, even here. In the summer, when you have this break here, that's kind of ugly. But the real ugly, let's find 2008. This is like super ugly. And you can see, and also strongly note, you're below the 200-day moving average. That's really bad. You do not want to be long any stock if the indices are below the 200-day moving average. Another just a simple point, I made a video the other day, I talked about the 50-period exponential moving average. If you're long a stock and it goes below the 50 exponential, that's also really not all that great. But you have two options. Let me close all these, 1 second. And this is also what another conversation I had with one of my students. They told me they're overwhelmed. They don't know which stock to buy. Well, there's another indicator I use, which makes it just so awesome, where you have the Explorer, where you can rank. I have it here somewhere. It's basically where I rank the stock market. I rank all the stocks, and I can identify the strongest stocks and the strongest sectors. It's an exploration I use. And then what I do is I limit it. And I only have, if I, like going back, I don't have that many stocks here. And maybe you know some of these stocks. Okay, GoPro, LinkedIn also. And then I don't change them that often. And I look for like here, like Alibaba. So I'm looking at a handful of stocks. Not getting overwhelmed. And in my book, The Bible of Trend Following, I talk about buying breakouts. A lot of people, they want to buy low and sell high. They call themselves value investors. I remember value investors with Enron and WorldCom and so many other, let's say even Warren Buffett, value investor during, let's say 2008. Cheap got cheaper. You know what's interesting? And I don't know what's going to happen with Alibaba, but use Netflix or Chipotle or whatever, Priceline. Expensive got more expensive. I mean, people say, I can't buy Alibaba. It's too expensive. It's $100. Or let's just, like I had this conversation today with a student. I can't buy Chipolita or Chipotle, whatever we call this thing. It's too expensive. It's $661 a share. Hopefully it'll open. Let's see. It's too expensive. But you know what? Maybe it's already made its move, but you know what? If it takes out 700, maybe it'll go to 1200. Who would have thought that Priceline would have gone to where it went to? And as much as it goes to these extremes, they can also fall. Like anything can happen when we trade. Here, let me jump back to the PowerPoint if we may, Dave. Actually, no, your PowerPoint, you have it. Sorry. Okay. So, quick summation, because I know there's a lot of, it's a lot of material, and maybe I'm going a little quick here. But using this tool that is based on Ned Davis research and Marty Zweig and my research, you can know the direction of the stock market. You can be aligned with it. And if you're aligned with it, you have a choice. You can try to pick stocks. And again, you can rank them. And I have a exploration that I use that ranks stocks. And again, I want to buy the strongest stocks in the strongest sectors. And I don't want to look at too many because then you get confused. I want to be focused. And to make it easy for people, because a lot of my students, they work full time. They don't want to sit in front of a screen. And also, guess what? I don't want to sit in front of a screen. So I have a handful of stocks that I look at as an added precaution. And I'll humbly say, I'm a scaredy cat. I want to be like a doctor where they use an x-ray. I want to have as much information, but not too much information. So I have my moving averages. I have my percentage from the high, my percentage from the low. But a very, very valuable tool is adding in distribution days, as well as follow-through days. My rule, take it for your own because it's a personal choice, when you have 4 distribution days, which I showed, which again, the definition here is right here, that one or more of the indices are closing down more than 0.2% on increased volume from the previous day. When I have a clustering of these things, that gives me another red flag. And what I do is I tighten up my stops, and sometimes I basically, because again, this is somewhat discretionary, it's like artwork, I take some of my profits. And the other thing too is, over, let's say, 25 trading days, the distribution days can fall off. But be careful with these. And again, what I do, again, and I suggest this, I'm an avid reader of Investor Business Daily. I read it every day. They post the number of distribution days on the NASDAQ 100 or the NASDAQ, as well as the S&P 500. And I find it extremely, extremely valuable and helpful for my trading. I showed this actually on the chart with the distribution days, and you can see you've had a clustering of them, and lo and behold, we turned down. But this is a very unique sell-off. This V sell-off reminded me of what happened in 1998, where we had the Asian contagion. Everybody was negative. All the smart money was negative, and we V'd up. That's why, again, during the ugliest times, you don't want to listen to the news. You don't want to listen to the doomsdayers. You want to follow rules. You want to have exact rules. The rules are, 1, know the turf. Should I be in the market? Or should I be out of the market? Or should I even be short, if you want to be short? And going short is that's a tough one also. It's not easy. But know the turf. Have rules. First rule, should I be in the market or can't be in the market? Rule 2, if I want to be in the market, pick what matches your personality and your risk threshold. You can easily, like, what's his name, Vanguard made a tremendous business by basically imitating the indices. But instead of just doing that, you can overlap these rules. You can trade the indices, and if you're more aggressive, you can trade the leveraged ETFs like QLD or TQQ or TNA, and quite possibly, if you want to rank the stocks like I do, which you might even want to do in a separate portfolio, you might stumble onto some big winner, like a Netflix or a Priceline, and have rules to stay with that stock. And you need to know, identify it, which I teach. The other thing is how much of it to buy, and then when to exit with a loss or a profit. And the other thing too is, again, I'm always thinking, because I have a lot of conversations throughout the day with traders, don't be afraid to take a loss. I mean, I've had people tell me they're an investor. They're a long-term investor when the stock doesn't work. Well, I mean, sometimes these stocks don't work and they end up like falling out of bed completely. Even the greatest stocks. Again, the Intels, the Ciscos, I mean, Yahoo. So you really need a plan. This is what this is all about. Trading is a journey. I'm still in this journey, which I call a marathon. And you know what? Don't beat yourself up for mistakes. There are going to be mistakes. That's why one of the first things I said is I have a trading journal. I keep a journal all the time. Every trade for everything. I go back and I look at it to see what I made a mistake. Maybe I didn't make a mistake and the trade just didn't work, which is fine. Because you put on a trade, it doesn't have to work. But there's only 4 possibilities when we trade, which I always say. You have the possibility of a big loss, possibility of a big win. You have the possibility of a small trade that works or win, and a small trade that doesn't work or small loss. But in order to be successful, you need to negate the big losses and try to keep your losses small. But you know what? We're dealing in uncertainty. Things gap, there's news, anything can happen. But if you can avoid the big losses, I'm going to tell you what happens in the real world. The small losses and the small profits, they offset each other. And the other reality is, at very, very rare times, you stumble into some trade that you step back and you go, wow, can you believe this trade? It's really unbelievable. And there are always those trades. You go back, again, Tesla, Mellanox, Netflix, Crocs. I can go on and on and on and on and on. That's why you want to have a journal to keep track of everything. So what I do is I use simple, robust trading concepts that have held up for decades. And again, it's not my beautiful thinking. This is, again, Ned Davis research, Marty Zweig. Again, they wrote a book, or actually Marty Zweig wrote the book in 1986. And for 30 years, it made 13.3%. I mean, that's amazing. When you compound that money, which is one of my books called The Bible of Compounding Money, you become very wealthy. So really what you have to internalize is you're focusing on money management, trying to keep losses small. And then you have very simple entries and exits. Okay? The reality is, unfortunately, most traders, they jump from an idea to idea to an idea to an idea. And people think simple is, it just doesn't work. And then the other thing is people quit. They get wiped out. They don't know what they're doing. Like I spoke to someone today about GoPro, and they took a loss and they hate it. And I said, what happens if GoPro, I mean, again, anything can happen, took out the highs and then just kept on going? It can happen. You never know what can happen, and that's why you need rules. And there will be these sideways markets that are very frustrating, that you take a lot of small losses. And there's people that said trend following is dead. Well, this year it's not so dead. It's really come back pretty nicely. As I showed you back here, this little chunk, and you didn't have to do that much, 21%. That's pretty impressive. A lot of people didn't do 21% with these simple rules. That's just one chunk. There's another piece here you could have had more profit. It could have come to maybe 40%. I didn't actually do the calculation. And you could leverage it up or unleverage it up by trading the QQQs or spiders or the triple Qs. You get to pick your own level of risk using these rules. So you really got to make this your own thing without listening to so-called gurus, because they don't exist. And if you try to follow somebody, invariably, I would tend to believe you'll lose money. So you got two choices using this methodology that I'm trying to give you guys today. You can actually trade it with ETFs, or you can actually try and pick stocks, and you rank them. Again, Alibaba, fundamentally, super profitable. You have all these institutions buying it. You broke out. We can look at Alibaba or any stock and we can discuss it. But you need to trade your own personality and your own time frame. I would also strongly suggest staying away from day trading. It's emotionally tough, hard on time, and I haven't really met anybody over the last 20 years who's been very, very successful being a day trader. I'm sure they exist, but I haven't really met them. Also, there is no get rich quick. There are always going to be losses. There isn't this 80% win rate or 90% win rate. When you hear that, you got to run. But what you have to do is keep the losses small. And there's rules for that. The other big problem is traders / investors, at the first drawdown, this system is broken. This money manager doesn't know what he's doing. They jump the ship. You have to accept the losses. There's no way to avoid them. There's no way to prevent them. The key is keeping them small. Take small losses. Again, you can basically use moving averages. You can use rules of certain percentages. This is what I teach. I already jumped the gun here because this is like so innate to me that you can have, there's only 4 possibilities when we trade. Big losses, small profits, large profits. But the thing is, you need to avoid the big losses. Okay? Because cut your losses short. Don't let them get big. Because they are emotionally devastating. Think of the next 1,000 trades. Again, I've been doing this for 20 years. Any one trade doesn't mean anything. Think in a series of trades. Also, watch my words here. Not the trade made money, the trade lost money. Trades either work or they don't work. And then you have to go back and do your post-analysis like, hey, when the plane crashes, they do like whatever it is. The National Transportation Board goes and figure out why it crashes. You want to figure out why you had a loss and then also why you had a profit. I jumped the gun again. There are no gurus. You have to work. I work. I'm up at 5 o'clock in the morning And actually, I'm overseas right now, and it's 1:30 in the morning for me. 1:37 to be exact. And basically, you can become your own guru. And I can help you become your own guru if you want. You can use MetaStock to become your own guru. It is really a great tool. And you know what? Don't think that you have to hit these massive returns, 50% or blah, blah, blah. You know what? Marty's wife was managing, if I'm not mistaken, I think it was $1 billion, maybe $2 billion. Okay, you hit anywhere between 12 to 15, 16% after fees, you'll manage a lot of money. You'll be very, very successful, and you'll be able to compound money. And this is what the key is. Don't quit. Stay in the marathon. There is no new greatest manager or great system, and it's like there's this Forex company that blew up recently with a $1 billion that was in the news, with 70 or 80% win rates. When you hear stuff like that, run. It's not reality. What it takes to succeed. A robust trading methodology that matches your personality, and you accept the realities of trading it. The other thing is, there are, like in my book called The Bible of Compounding Money, there are money managers that have been around for decades. And then what I do is I buy them when they're in a drawdown. Or when they're on sale, you can say. I don't think they get stupid all of a sudden. But then you know what? Past performance is never indicative of future performance. I've given money to guys that have been around forever. I might have bought their 20-some-odd% drawdown. And then it got worse. And I closed the position. And guess what? We're dealing with uncertainty. Complete uncertainty. What it takes to fail. Not having a trading plan. If you don't have a trading plan, knowing what you should buy, how much to buy, when to get out with a loss or a profit, guess what? You should not be trading. You really shouldn't be. Because I'm going to guarantee you're going to lose. And the other fact is, unfortunately, probably 90% or more people lose money trading and quit. That's not my goal. My goal is to help you, and actually I have a wife, I have 2 dogs, I have 3 kids. So I want to be doing this for the next 30, 40 years, God willing. So I have a trading plan. You don't want to over leverage. You must contain money management and risk management. And that sounds very trite. Everyone talks about risk management, money management. This is what I focus on. Risk per trade, risk per sector, portfolio risk. Where I don't want to risk, and believe it or not, in one of my portfolios, I'm risking 0.4%. And in my more aggressive portfolio, I'm risking 75 basis points. That's 0.75%. That's it. The other reason people fail? Lack of patience and discipline. They jump around, idea to idea to idea. They'll buy trading book after trading book. And you know what the point is? Because they're looking to avoid losses. You can't. You can't avoid losses. What I do, again, I trade for a living, but I do one-on-one mentoring hourly, or I also do actually locations where I travel to, let's say, banks or hedge funds, things like that. I help you develop your own trading plan. I help you use the tools within MetaStock, help you develop risk management and money management. And you know what? The most important thing is this one right here, this working on trading psychology. It's the words have so much power, like the trade worked, the trade didn't work. It's not you made money, you lost money. How to deal with a series of trades that don't work, and there will be. This is the most important thing of trading. Also, there's some great MetaStock offers. Actually, that's more of Dave's field, but I'm also one of their, I guess, partners. And here are their offers. And again, you can email me. Whatever I can do to help you, I'm here to help you. And again, with these indicators, gladly give them to you. I don't charge for them. You can contact me right here. And if you want, I can even send you this book, this one. This one I did with Wiley Books, so it's really not mine to give away. But this one I can give you. If you want, you can just email me at this, and I'll give you the book. I think that's all I have. And I'll throw it back to Dave. Or I'll throw it back if there's any questions, actually.
Yeah, let's see if anyone in the room has a question for Andrew. Anybody would like to ask something or a follow-up in nature? Looks like we have a quiet group. You're all very shy.
Except us. Okay, well anyway. No, I'm sorry.
No, very good. I just wanted to say great presentation. Definitely take up Andy on the free book. Take down his contact details, send him an email. It's fantastic information right there for you. Great presentation. I learned again every time I hear from you. Thanks everybody for joining us, and special thanks again to Andrew Abraham for a terrific presentation.
Thanks, Dave. Thank you for having me again.
Thanks everybody. Have a great evening. Best of luck in your trades.